The Minority Market. Episode 10. How does money flow between market participants? Most people look at the stock market and see only prices moving up and down. They assume prices change randomly or only because of news. This surface-level understanding keeps the majority confused, reactive, and emotionally vulnerable. In reality, prices move because money flows between different market participants, each operating with different goals, time horizons, emotions, and constraints. When you understand this flow, the market stops feeling chaotic and starts making sense. Every transaction in the market has two sides. For every buyer, there is a seller. Prices do not rise because everyone is buying, and prices do not fall because everyone is selling. Prices rise when buyers are more aggressive than sellers. Prices fall when sellers are more aggressive than buyers. This imbalance between urgency and willingness is what drives movement. Price is simply the agreement point between opposing decisions. Market participants are not one uniform group. They include long-term investors, short-term traders, institutions, funds, hedgers, and retail participants. Each group behaves differently. Long-term investors focus on business strength and future potential. Short-term traders focus on price movement and volatility. Institutions manage large amounts of capital and must think about liquidity, risk exposure, and timing. Retail participants often react emotionally to price changes and news. These differences create friction, and friction creates opportunity. A common mistake beginners make is believing the market is a fair and equal battlefield. It is not. Large institutions cannot enter or exit positions instantly. Their size forces them to act slowly, often over weeks or months. This creates visible behavior in price, periods of accumulation, consolidation, and distribution. Retail participants often mistake these quiet phases as boring or meaningless, while the minority understands that these are often the most important phases. Money flows in cycles, driven by human emotion. During optimism, capital flows into risk assets like equities. During fear or uncertainty, capital flows out into cash or safer instruments. These shifts are not logical or perfectly timed. Greed usually peaks near market tops, and fear usually peaks near market bottoms. Understanding this emotional cycle helps you avoid being pulled into extreme decisions. Another important concept is rotation. Money does not enter or exit the market evenly. It rotates between sectors, industries, and themes. While one area is attracting attention and excitement, another may be quietly accumulating capital. Beginners chase what is already visible and popular. The minority watches what is being ignored, where money is slowly positioning before the crowd notices. Liquidity plays a major role in how money flows. Large participants need sufficient liquidity to transact without causing sharp price movement. This is why prices often move sideways for long periods. To the majority, this looks like nothing is happening. To the minority, this often signals preparation. When liquidity conditions change, price moves suddenly, catching the impatient off guard. News does not create most price movements. It explains them after they happen. Major money decisions are often made before news becomes public. By the time headlines appear, much of the money flow has already occurred. This is why prices often move before announcements. Beginners react to news. The minority observes price behavior to understand positioning. Many beginners believe smart money always wins and retail always loses. This is an oversimplification. Institutions also make mistakes. The difference is not intelligence, but structure. Institutions manage risk, size positions carefully, and think in probabilities. Retail participants often lose because they overtrade, overreact, and ignore risk, not because they lack intelligence. Time horizon plays a critical role in money flow. Short-term traders create noise and volatility. Long-term participants create trends. When these two interact, markets become unpredictable in the short term. Understanding which group is likely active helps you interpret price behavior more accurately. Slow, steady price movement often reflects participation by longer-term players. Sudden spikes often reflect speculation. Sharp drops often reflect panic or forced selling. Each type of movement reflects a different type of money flow. Recognizing this prevents emotional overreaction. The minority does not try to predict exact money flows. Prediction creates attachment. Instead, they observe behavior. Is price being accepted at higher levels or rejected? Is movement smooth or erratic? Are pullbacks shallow or aggressive? These questions reveal who is active without needing inside information. Another important shift is understanding that money avoids uncertainty. During unclear conditions, capital waits. This creates boredom and frustration. Beginners force trades during these periods. The minority respects inactivity. Waiting is a position. Cash is a position. Emotions drive money flow more than logic in the short term. Fear accelerates selling. Greed accelerates buying. Over time, business fundamentals assert themselves, but the path is emotional. Recognizing this helps you detach from short-term noise and stay aligned with long-term thinking. A powerful mindset shift is to stop asking, "Where will price go?" and start asking, "Who is acting right now and why?" This single question changes how you see the market. You stop chasing outcomes and start observing behavior. Another useful exercise is to watch reactions, not events. When news arrives, how does price respond? Strong reactions indicate imbalance. Weak reactions suggest expectations were already priced in. This teaches you to read money flow without emotional involvement. The majority seeks certainty. The minority accepts uncertainty and focuses on context. Money flow analysis is not about certainty. It is about understanding probabilities. Context improves patience. Patience improves decision quality. This episode builds directly on the previous one. You now understand what a stock represents, and now you understand how ownership changes hands. Together, these concepts form the foundation of market awareness. You are no longer just watching prices. You are beginning to see participants, behavior, and intent. This shift is subtle but powerful. It is one of the first real signs of moving away from the majority mindset. The minority does not chase money. They observe how it moves. Over time, observation becomes understanding. Understanding becomes patience. And patience becomes consistency. Markets will always appear noisy to those who look only at price. To those who understand money flow, that noise becomes information. Build this understanding slowly. It will protect you far more than speed ever could.